So that sort of covers all the, so we've just sort of talked about the business structures and the options.
Yeah.
So would you mind just sort of trying to explain a little bit about when we should start paying tax and what numbers we need to be aware of?
Okay. Well, I'll try not to bore people too much on the tax side, so again I'll try to keep it quite sort of brief as possible anyway. Taxes and everything else. If you're a sole trader or a partnership, you pay income tax and national insurance, which you do if you're an employee as well. So if someone's employed, then you pay what's known as PAYE income tax on your salary and everything else, which probably most people are used to, and also national insurance. So at the moment, income tax, personally, if your income is over £8,105, you pay income tax. National insurance threshold's a little bit lower, but you pay 12% employees' national insurance. So if your income's over £8,000, roughly speaking, you pay 20% income tax and 12% employees' national insurance if you're an employee, which you would be if you're a limited company. Go back on the sole trader side of things, the same thing applies, but you actually pay income tax on 20% on your profits over 8,105 if you're not using your tax-free amount, your personal allowance against anything else. And then national insurance, you have to pay on your profits as well, which is at 9% on about the first £40,000, £42,000 worth of profits, and then it dips down to 42%. If your profits are over 40,000, then unfortunately you pay tax when you're a sole trader or a partnership at 40%.
Right.
So it gets a bit expensive.
Hence when you need to look
that's a bit of a trigger point to maybe think about moving over to a limited company if you're a sole trader or a partnership. And then there's other thresholds, the real nasty ones. If your income's over 100,000, which is nice, you start to lose your personal allowance. If you get £1 worth of income, you're paying tax at over 60%. And then 150,000, it's 50% at the moment, or 45%. There is a nasty little trap which has come in on child benefit, where you start to lose your child benefit if your income's over £50,000. You lose all of it, you've got to pay it all back again if your income's over 60,000. So it's come in from January 2013, and I've got one particular sort of client, I've got quite a young child. His income isn't that bad, he can't move any bit around to his wife. He's paying 40% income tax, 2% national insurance, and 13% he's going to pay back on his child benefit. So, not very nice position. So every pound he makes, or every extra pound of salary he gets within that 50 to 60,000 threshold, he's paying 72% tax. So,
wow.
Not very nice, really.
But that's only on the bit that he's over?
Yeah.
Okay.
So that's sort of how income tax and national insurance, that's what you would pay if you're an individual, or you're a sole trader or a partnership. If you are a limited company pays corporation tax. So corporation tax is a little bit less, hence the advantage. It's 20% on the first £300,000 worth of profits you make.
Right.
So it's a big difference.
Yeah.
Then what you do, in essence, the company pays its corporation tax at 20% out of its profits. So say the profits are 50,000 for argument's sake, take off 10,000 corporation tax, that leaves you 40,000 profits, and then you distribute the profits by way of dividends to the individuals. So what will probably happen is the individuals will take a salary from the company, which is often quite close to the personal allowance, so they get use their tax-free amount, and then everything else is taken by way of dividends. And basically, if someone's taken a salary of say £8,000, which is just a little bit less, just on to use your tax-free amount, you can approximately, have about £30,000 worth of dividends without paying any personal tax at all. So in the company situation, you're paying 20% corporation tax. In the individual situation, you're paying 29% sort of tax, which is 20% income tax and 9% national insurance.
Right.
If you take dividends over and above your sort of basic rate band of tax, which is 42,500 approximately at the moment, then you pay personal tax at 25%. That's why you see a lot of husband and wife companies, because basically they can take out the best part of £75,000 out of a company, limited company, as long as they've got the other income without paying any personal tax. So
those limits that you've just said, that would count if you had like a part-time job. It's what you Yeah. Okay.
So you do need to sort of factor it into mind. There's one planning point I've got really, and if you've got other jobs, and then you've probably used your personal allowance or your tax-free amount against that job. So you do need to project forward and work out what your tax is going to be, because you won't have a tax-free amount because it might have been used against your other job. In which case you just need to do some projections again with your accountant, get him up front or her up front to actually do some numbers for you and say this is what your liabilities are likely to be, and then you know, and you keep some cash aside in a deposit account as you go through.
Right. Okay.
So that's the tax. You've got tax, national insurance. When you're self-employed, when you register as being self-employed, you have to also pay some more national insurance.
Right.
To give you your qualifying year for state pension purposes, and it's known as Class 2 national insurance contributions. They're not too painful, so they're £2.65 a week.
And does that happen automatically, or is that something we'd need to do?
You need to do that.
Okay.
So we're going to come on to registering.
Okay.
As you register, that's part of that sort of process. So there's a form you need to, we can go online and do it. There's a form you need to complete to the revenue, and that gets you in the system on how to register for income tax, as it were, and that means you then pay your £2.65 a week, which you can either pay by direct debit, which you pay monthly, or alternatively you pay it every 6 months.
Right. Okay. And you'd need to do that if you wanted to go on maternity leave or something like that. You'd need to be contributing to your.
Well, sometimes it's, you wouldn't need, if your profits are below. There's a small earnings exception in it,
right.
which I've got the figure. Let me just remind myself. It's about 5,500. Yeah, in the current tax year, I was right. 5,595. Where if the profits of your business, which if you're looking at a small business, often is to start with, then you wouldn't. If you're a sole trader, then you wouldn't have to pay any Class 2 national insurance if you applied to the revenue. You might apply up front, they don't just give it to you.
No, okay.
And you might say, well, I'd quite like the sound of that, so I don't want to pay it. It's not that much, but I don't want to pay it. But just beware that £2.65 gives you, when you're self-employed, if you haven't got another job, a tick in the box for state pension purposes. So it's worthwhile paying.
Yeah.
However, slight change again. If you're a parent, say a mum, you've got a business and it's right alongside your husband or the other way around. It's got a job. This is a bit more of a sort of hobby type sort of business, and which often happens. You're looking at sort of you've got a child who's under the age of 12. You receive child benefit in that particular case. There's a change a couple of years or so ago where basically if the child's under 12, you get tick in the box to say you get a state pension for that year anyway, so it falls out of the equation.
Okay.
So in that scenario,
you
would probably apply for the exception if your profits are likely to be below £5,500 a year, so you don't have to pay it.
And that's profit, not turnover.
Correct.
Okay.
Yeah, it's definitely profits, which some people forget really. So it is after all your expenses, so do claim what you can. So obviously it's genuine business expenses. But again, you probably just need to have a chat with someone, do some projections and everything else. Sort of look where you're at. Often though, you find, especially the business is starting off at quite a small level. You're looking at a craft business, for instance, and profits will be below £5,500. If you've got a young child who's below 12, then when you do the registration process, then you apply for this certificate. When your child's over 12, then you might say, look, I want to pay the Class 2 national insurance, because it gives you another tick in the box for state pension purposes. So it's worthwhile because it's quite cheap, really. For getting another qualifying year. Corporation tax for companies, one tax, not a very nice tax, to look out for businesses anyway, is VAT. So you've got to do a reasonable amount of turnover, a reasonable amount of trade. £77,000 is the limit before you have to register with VAT. And then you are really an unpaid tax collector, insofar as you've got to charge 20% on your sales, and you obviously get to collect that sort of money, but you deduct it off your expenses, so you can claim the VAT on your expenses.
Right,
so there is a sort of threshold. It's quite high, 77,000. In other countries it's an awful lot lower. Sometimes it makes sense to voluntarily register for VAT, so that if you're working for mainly sort of businesses and VAT registered sort of businesses, you charge them 20%. It doesn't make no odds to them. It's a bit of a cash flow disadvantage. They then recover the VAT, but you then recover all the VAT yourself on your costs and everything else. It's a bit of a faff, unfortunately. You've got to fill in quarterly VAT returns, so there is an admin downside to things. So, but that's another sort of
it's just so if you were to register as VAT, there's a lot more. There's a bit more accountancy work, so there's costs associated with that. And
so you've got to pay someone to do it, either an accountant, a bookkeeper, or it's going to cost you in your own time. So there is a downside to it.
And if you're a service-based business, it's not it's worth putting off until you reach this rate, isn't it? You wouldn't if you were just selling your time. So you can't claim much back. There's no.
It's worthwhile. If you haven't got much to claim back, you might say, well, I'm going to save myself a few £100 a year, but I'm going to save myself that sort of time. I'll enjoy myself. So you wouldn't register with VAT because there's not that much VAT you're recovering back on your costs. Because it is mainly you. So alternatively, if you've got a lot of sort of VAT, if you're buying sort of products and everything else we've got VAT on and you're reselling them, you might say, at least think about whether to register for VAT. And if you do, then you've got the hassle factor of having to do the VAT returns. It's not only difficult when you get into it, but it is another administrative burden, really.
Okay. And I used to be on the flat rate VAT scheme, so is that something that small businesses would be better off looking at, or is it completely per case?
Unfortunately, not the answer you want to know. Unfortunately, it is by case sort of basis. So there's a couple of things on VAT. You mentioned a good point. There's a couple of sort of planning sort of points there. There's VAT, which is you can use the cash accounting system or flat rate. So cash accounting, you pay for VAT, or you account for VAT when you're actually sort of paid yourself. Which means you haven't got this cash flow. So you raise an invoice to someone, that's your trigger point for VAT, and then that goes on your VAT return.
Regardless if they've paid you.
So if they don't pay, then you've got a bit of a cash flow disadvantage. So I did an exercise for, actually it was a haulier, I think it was sometime last year, and we just switched him across from an invoice basis. So he paid the VAT when he raised his invoice to when he was received. And it saved him several £1,000 at quite a difficult sort of time. So it is worth sort of looking at, really, as to whether you just pay it in line, especially when you've got customers or clients who actually there's a bit of a lag between you raising the invoice and you getting paid, which hopefully shouldn't be too long. You can help it, because obviously it's going to have an impact on the business. But Vicky, you mentioned another good point there. There is a simpler scheme, a flat rate VAT, so you still charge VAT, so you've still got the disadvantage of having to charge 20% VAT to your clients, your customers, but then you actually pay a flat rate percentage. So rather than have to keep detailed records, splitting out the VAT and all your sales invoices and all your expenses, you just add up all your sales invoices plus the VAT and times it by a set percentage set by nature revenue in customs. Which sounds very simple, but it's designed to put you in exactly the same position cash-wise as if you were doing it on the traditional basis. But it never works out like that. Some businesses it works, some businesses it doesn't. And I've got clients that it saves them £3,000 or £4,000 a year. It's much simpler. Slight complications. You're going to use it to enable your sales up to 150,000. So if you're starting up and you want to be VAT registered, then that will probably apply, and then you can stay in the scheme to about 230,000, I think, sales go up. So for some businesses though, they collect their 20% on the VAT. They've got not much in the way of costs, which have got VAT, and then they pay over VAT maybe at 14%. So it's not quite a case of just saying 20 less 14 is what I gain, but it isn't far off for them. For some businesses, again, it's worthwhile thinking about. It's a lot easier for some businesses, and I've got clients who it works for them. They save themselves £2,000, £3,000, £4,000 a year. It's better having it in your pocket, as you might say, than in someone else's. So,
okay, that's really helpful.
VAT, if you're starting out, it's a bit of a pain. There is one thing: if you don't register on VAT on day one, what you can actually do is, I don't really want to go down. I want to see how things go, and whatever. You can go back. So if you say in a year's time, I want a VAT register. Then basically you can go back and claim the VAT on your goods in the previous 3-4 years. as long as you've still got the goods on hand at the date you VAT registered, which is often the case for, say, a computer.
Yeah.
Not often the case for a pen,
No.
because it was a pen, you've consumed it, and you've got an invoice in the company or the business's name, and you go back 6 months for services, so accountancy fees.
The training and stuff like that.
If there's any VAT on some stuff and it's a service, then yes.
Okay.
So you don't totally lose out by not registering on day one. So if you've got a small business,
and at what point would you? So is it as soon as the last 12 months turnover is £77? Should you say? So is it a rolling figure? Like
it's a very good point again, because I've had people come to me and they think they've done their annual accounts.
Yeah.
One in particular. And he thought, well, I'm just below it. I haven't got to worry about it now for another year. He didn't want to be VAT registered. But unfortunately, it's on an annual rolling monthly basis. So where are we? We're in February now. Just did the February. So we look at the sales for the 12 months to February 2013.
Yeah.
However, we then go to March 2013. You add on your March 2013 sales, and then your March 2012 sales knock out. So it's done on the 12 months to March 2013. If you're over 77,000, then you've got to register for VAT at that point in time. You get 30 days. To register, and then it takes effect. So say you went over at the end of March, you've got the whole of April 2013 to register, and then you registered for VAT from the 1st of May. So there was a little bit of a gap, not much, mind you.
No, but and what happens if you didn't notice? Like, can you get fined?
Yeah.
Right.
And it can be quite nasty. So again, you need to monitor it quite critically, because there's penalties there, set penalties from the revenue, and the longer you leave it, the worse it will be.
Right. Okay.
And I've had a client in that sort of circumstance, really. So but we did do quite a nice exercise, and we claimed quite a lot of costs, which he was generally able to claim, reduce his liability. But if we hadn't been able to, he'd been in a bit of a pickle.
Okay. I think it's a really important point of always keeping on top of the accounts, because I know I used to be like it, and I've spoken to other people that keep all the receipts in a box and don't really know what goes on year to year. And if you've had, and especially when you're busy, that's when your turnover's gonna. So
it is again a case of keeping the receipts. You can't claim the VAT. If you're registered VAT, you can't claim the cost unless you've got a genuine invoice.
And just to be clear, that this is on turnover and not profits, isn't it, VAT?
Yep.
Yeah.
So
even if you're not making any profit at all, you still have to pay VAT.
If your sales are over 77,000, correct.
Yeah.
So there are a couple of other taxes, which I won't go through, because there's capital gains tax if you're selling property, shares, and those types of things. And unfortunately, there's a quite nasty one, inheritance tax, which when you pass away, there's some inheritance tax on your estate, but they're not genuinely sort of business. I won't go through those today.
No, brilliant. All right, well,
so that's all the taxes.
Okay, that's
stamp
brilliant.
duty as well, land tax, but that's something else.
Okay, yeah, no, this is I think the VAT and the tax and the national insurance are the things that.
The main ones for business. So the other ones are sort of stamp duty, land taxes, property orientated, capital.
Something for the future.
Yeah. Anyway, we want to chat though. Having said that, then obviously give us a shout. And obviously advise on all those taxes as needs be, which do it through the life cycle. So when they do come into play somewhere along the line.
So at that point you find you speak to your accountant.
You just speak to us and say what's going on here, really. So,
brilliant.
Okay.
Thanks, Chris.
Taxes.
Brilliant. Thank you.